Types of finance. Debt finance. Debt finance refers to the money you borrow to maintain or operate your firm. The money lender does not have control over the debt. The borrower must return the principal amount plus the agreed upon interest rate. The interest rate is usually decided by the loan amount, duration, reason of borrowing, kind of funding, and inflation rate. Short-term debt finance refers to loans that are needed for longer than 1 to 180 days. These loans are taken out to cover financial shortfalls as well as temporary or regular needs. Short-term financing is primarily necessary for day-to-day business operations, such as paying employees' paychecks or procuring raw materials. Long-term debt financing. Medium-term debt finance refers to loans that are required for a period of more than 180 to 365 days. Businesses use this sort of financing to buy things like equipment and fixed assets. Long-term debt capital. This sort of financing is typically used to purchase equipment, land, or restructure offices or buildings for a firm. The interest rate on long-term debt is lower than on short-term debt. The repayment period for this debt finance is commonly 5, 10, or 20 years. Number 2. Equity capital. Equity financing is a traditional method of obtaining funds for a firm by issuing or selling stock. This is one of the most significant distinctions between equity and debt financing. This type of funding is typically used for seed funding for new firms and startups. This type of financing is used by well-known companies to raise more funds for business expansion. Finances public. The study of the state's expenditures and revenues is known as public finance. It considers the finances of the government. Don't forget to like and subscribe.